Hey everybody, hello. Welcome to the Thursday financial thing, investing, peer-to-peer lending live stream. Hope you are doing really well this evening. Thanks for tuning in. It is a very mild 21 degrees centigrade here in Orlando. Beautiful day, sunny, of course. And we have a lot to talk about this evening. Peer-to-peer lending. We're going to take a look at the Able Rate administration proposal. I finally had a chance to read it through. Just some thoughts, some pretty interesting things in there that I wanted to comment on. Take a look at some of the news on a day, by the way, today when it was discovered that dish soap has gone up 46% since 2019. Quite a big jump. Sports drinks up 80%. Even bread up 34%. That's in the US. I don't know what the numbers are in the UK. Presuming it's pretty similar. But again, why I bring this up is because you got to find a way to protect yourself from inflation. These inflation numbers are real. And also on a day, today of April 4th, that we discovered that the Italian police have recovered about 650 million euros of assets that were purchased using fraudulent schemes, fraudulent methods to get free money from the government under the COVID recovery fund that the EU put out to help save people and businesses. And no surprise there that there has been a bunch of fraudsters out there that have used these COVID monies for their own lining of the pockets to buy Rolexes, Lamborghinis, villas, cryptocurrencies, whatever it is. They've used it. I think it's great they got busted. I think there'll be many, many more of these stories that come out. That is a lot of money. 650 million euros, 600 million euros. God, you can read about it. It's all over the news. But anyway, you don't care about that right now. You care about what you came to hear, peer-to-peer lending news and investing. By the way, we'll take a look at the Trading 212 portfolio later on in the stream. And I took a loss. This week. I'm going to have to show you what that is. But in the meantime, Cufflink, of course, the sponsor of this stream. And, of course, the sponsor of Harley Cam. There she is having a good snooze. Ready to learn all about investing in peer-to-peer lending. Thank you to Cufflink. You can earn up to 9.83% gross interest per annum. There is a bonus rate right now. You can get more than that. And they've got over 300 million now property-backed UK investments made since 2016. Zero in investor losses to date. Of course, that doesn't mean that will always be zero. It is an investment, so you will probably have loss at some point. But remember, your capital is at risk. Very important. Don't invest unless you're prepared to lose money. This rate can change as interest rates change. You can sign up at join.cufflink.com/financial-thing. Link is in the description below. If you don't have a Cufflink account, go sign up for a freebie. A quick hi to everybody who is out there now live and watching. And in the future, good evening to Mark Mason. Dave Dawson is here, linefish hunting in Grand Cayman. Colin Perry in the Peak District. Also me, of course, in sunny Orlando, Florida at the moment. Let's get right into into the news. I'm going to try to keep it short and sweet this evening. Got an email today, or yesterday, from Cufflink announcing a new investment forecast calculator. Of course, they made the announcement showing about the reserve pool allowance that is under the auto invest feature, so you can see how much money there is being weighted to invest in the auto invest feature. But now they have introduced this. I think it's pretty cool. It's an investment forecast calculator that you can put in how much money you are planning on investing. It would show you what you could expect to receive at the end of the maturity or monthly, depending on the selected product and term that you choose. Now, I'm just going to show you how to access that because Cufflink has been making changes to their website recently. So if you go here on Cufflink's website and you click on portfolio, where is it? Now I can't remember. If you go to auto invest, right here, and if you pick something you want to invest in, I think now I can't remember where it is, of course. Hang on a second, I'll find it, because I just literally looked at it. Maybe it's in the select. Let's have a look. If we click on a project, where is the investment? Now I can't find it, of course. Maybe I have to go back to the email. It says forecast returns on the right side of your screen. There you go, of course. Right side of the screen. I'm coming off very amateurish right now, but that's what I do. You know, everything is live here. When you select a deal, select auto select. You'll see a new button called forecast returns. Okay, let's try this again. So let's go to auto. We're going to click on the 2-year. Oh, yep. Where is it? It was here. I swear to God. Oh, here we go. On the right side, right here on forecast returns. It's not in the usual fuchsia color, so it was hiding from me. But yeah, you can go ahead and put in how much you want to, thinking about putting in. And it will show you here, paid on maturity, 2,402 is the estimation at 10% annual returns. Or you can take the annual payout if you decide to do that. So instead of taking it all as a lump sum, after 2 years, you can get it paid annually at 2,384, 3 years, 5 years. See, there's not a whole lot of difference between the 3-year and the 5-year, about £300. But I think it's a good calculator too, because it shows you the Bank of England base rate here down on this yellow graph line. I always think it's better to take the annual payment personally, rather than letting it go on to maturity. Just there isn't that much difference between what you actually get paid out, so 105 difference, but I think it reduces your investment risk a little bit if you do take that payout annually versus letting things roll over to the full maturity amount. So that would be what I would personally do, but of course that's up to you. But an interesting feature that was added to Cufflink. Rebuilding Society has requested a fair competition review by the Financial Conduct Authority. Rebuilding Society Chief Executive Daniel Raj Kumar, who I'm hoping will come on the stream one day, hopefully within the next 3 or 4 months. He has said he would like to come on the stream, but he is waiting for something to be approved at his company before he comes on the stream. So we'll see. Daniel come on the stream. But Daniel, who is the chief executive at Rebuilding Society, has urged the FCA to review its high-risk investments policy, arguing it places peer-to-peer lenders at a competitive disadvantage. Mr. Raj Kumar has said there should be a blanket ban on incentives offered in connection with all regulated financial services, meaning that the value judgment is predicted solely on the pricing of the service proposition. He also added, as an IFISA provider, we find it very difficult to compete to win customers when my competitors are allowed to incentivize offers, but we are not. I think it's a very fair argument, because this is basically about the fact that the FCA banned peer-to-peer lending companies from incentivizing customers to try them. Anybody that's been investing in peer-to-peer for a while, you know that you got to get things like cash back, promotions that we used to all take advantage of when we wanted to try new companies out. And now, of course, the FCA has stopped that, basically putting peer-to-peer lending into the same basket as equity investing. So that would be crowdfund investing through companies like Cedars, who offer shares, and also cryptocurrency investing, which, you know, some would argue is a far riskier proposition, which in 99% of cases, absolutely true, unless you invest in Bitcoin, which is not as risky. But because you have thousands of very, very risky cryptocurrencies, then yes, it is extremely risky compared to peer-to-peer lending and should not, in my opinion, be placed in the same basket. I also believe that if you are going to ban financial incentives, I've said this before, that it should be banned through all the companies. Like, why should a company like Trading 212 be allowed to offer us incentives and cash back? Because on a company like Trading 212, you can buy very, very high risk shares that most people will lose money on, but they don't get put into that same category. The reason why, it's all down to money. Stock market investing companies, way, way bigger than peer-to-peer lending. They have money to influence the way the government decides on things, and lobbying, regulatory things like that, and decisions. So peer-to-peer lending just gets put into this very, very high-risk basket. So I'm on board with you, Daniel. I think you're exactly right. I think that should be reviewed. Do I think it's going to change? I don't think it will change because oftentimes these regulatory bodies like the FCA don't want to repeal decisions that they've made because it makes them look bad. And there's obviously a reason why they did this. British ISAs could add £59 billion to UK savings market. This is to do with the proposed spring budget where Chancellor Jeremy Hunt said that they're going to increase the ISA wrapper from £20,000 to £25,000 per person, which is huge. I don't know if you know this, but in the USA, a basic ISA here that anybody can take advantage of is about $6,000 US. So what is that, £4,800? So to get £25,000 in a wrapper in an ISA is huge. That extra $5,000 they're estimating could bring in around 59 or 60 billion extra pounds into the savings market. So whether that's a cash ISA, IFISAs through peer-to-peer lending, or stocks and shares ISAs. Why do you care about that, by the way? Well, you care because, number one, if you're a stock market investor, you imagine an extra 20, 30, 40 billion pounds coming into the stock market through investing through ISAs. That's going to levitate the market somewhat. Even though it's not a massive impact, but it will impact it in some way. Also having some of the numbers that came out, Propland put out a good newsletter highlighting some of these ISA numbers that came out in the reports. And I'll go through that. But that's a pretty big addition to the ISA market. I hope that goes through. I think it's the only gift that the government gives to us is those ISA allowances that are tax-free. Take them. By the way, you have till tomorrow, Thursday, Friday, April 5th, to put your ISA allowance in for this remaining tax year. So if you haven't done it yet, do it if you can afford it. Even if you can't afford the whole thing, you can't put in the 20, put in one, put in 1,000, 2,000, whatever you can afford. Take advantage of that gift that the government is doing because they're going to tax you otherwise. So take the gift. Let's talk about Propland in their newsletter. They talk about death and taxes in this world. Benjamin Franklin said there is nothing certain except for death and taxes. Now, they also talk about the ISA on this newsletter, and some of these numbers I thought were pretty cool. Again, another reason you need to use your ISA allowance, which is very important. I'm sure most of you are, but if you're not, do it. The latest figures from HMRC for the 2021/22 tax year show a pullback with an estimated 66.9 billion paid into 11.8 million ISAs. And you get your head around that. 67 billion pounds in 1 year came into UK ISAs. Roughly 30.9 billion of that was to cash ISAs. Think that's a mistake, personally. You know, those inflation numbers don't lie. If you're using cash, you are going to lose money to inflation. So I'm surprised that's such a high amount. 34.2 billion was put into stocks and shares ISAs, with the balance in lifetime and IFISAs. So not much going to IFISAs. Talking maybe Well, we don't know exactly what that number is, but it's around less than $3 billion. As of the end of 2021-2022 tax year, $741.6 billion was held in ISA accounts. That is crazy. 62% held in stocks and shares ISAs. So we're approaching £1 trillion of money and investments that are being held in ISA accounts. A more astonishing statistic is at the end of 2019 and 2020 tax year, there were 1,480 ISA millionaires. But by the end of April 2021, that number had almost tripled to 4,070. That means that because the stock market really had a hell of a run, there's been a lot more millionaires created through the ISA. According to data from the Open Work Partnership, the average ISA millionaire was sitting on a pot of just under £1.4 million. The top 50 ISA millionaires were sitting on pots averaging $8.5 million. God, you people are rich. With the top 25 ISA investor pots holding an average of £11.6 million. Not sure I agree with this statement, but they say, Propland says, given the returns achieved to these numbers, those investors most likely had very successful individually stock picking rather than invested in funds or trackers. Yeah, I don't know about that. Cash ISAs have outperformed the returns from stocks and share ISAs over the past year, but the innovative finance ISA continues to come out top. Propland's Tranche A over the same period within the ISA wrapper returned 7.34%. The average cash ISA returned 3.73%. And by contrast, the stocks and share ISA funds saw 2.8% growth during the same 12-month period after falling by 3.27% between February 2022 and 2023. I still think, personally, a mix of the peer-to-peer lending ISA and the stocks and shares ISA is definitely the way to go. Long term, I fully expect stocks over the very long period of time, index trackers and things like that will outperform certainly peer-to-peer lending for sure. We'll see if that turns out to be true. So interesting statistics on the ISA. I had an email from the email bag, and the question subject was, would you still, ? This was sent to me in January. Ahoy there, Lawrence. Captain Barry here. I actually captain boats, hence my name, LOL. Interesting. Anyways, quick question for you. I know you've been investing in peer-to-peer lending since about, typo there, 2015/16, as have I, for better and for worse. If you were to go back and do it all over again, would you still invest? What would you do differently? I always listen to the catch-up on the YouTube stream, so maybe this email makes it. Cheers, Baz. Good question, Barry. Thanks for sending that in. Really two answers to that. If I were to go back to 2015, travel back in time, and I knew what I knew today, would I still invest? I would say no. And the reason being is because obviously there were so many peer-to-peer lending companies that bit the bullet and failed. And the information out there was not out there, right? So you didn't have websites like Fourth Way, Financial Thing, and more review websites and things to really know what those companies were like. And plus they were launched. A lot of the companies were launched after 2015, so we didn't really know what they were like. Now, the problem with casting a wide net of investing back then was you're going to pick some winners and pick some losers, just like the trading 212 portfolio. There was the rate setters, there was the Wellesley's, there was the funding circles, the Zopas, the Able Rates, the Lendies, the funding secures, the money things, on and on. And then on top of that, and future down the road came the loan pads and the prop lends and the blend networks, Cufflinks, Unbolted. When you're casting a wide net and you're casting some that fail and some that don't, return-wise, you're not going to do that good. So if I knew obviously what I knew today, well, the obvious answer would be I wouldn't have invested in the ones that failed, of course. But let's say I didn't know that, and I didn't tell myself that, and I just had to pick whether I would invest again, I would say no because of the lack of information. If I was doing it today, would I invest? Absolutely. I would invest because I know way more information now because of the websites that are out there. And I think it's a lot easier to pick the right companies now than it was 8-9 years ago. And I think some of the companies have done fine. You know, even the big three, right? Zopa, lending, Zopa and RateSet are particularly return funds to the investors, which is the most important thing, not to experience losses. So there was that. There was a positive outcome. Lending Works also returning money, even though the returns over the pandemic weren't very good. And of course, we just have to take the failures as part of the experience of investing. Kind of, again, like the trading 212 portfolio, which I've had many failures within that portfolio. That's the most difficult thing about investing. Again, that's why I love index trackers, because I don't have to worry about trying to pick the winners and the losers. I could just choose one thing. If I knew peer-to-peer lending, I could just pick one company. I wouldn't have to worry about failure. That would be the easiest way, right? So Barry, yes, would I still invest? I would say if I was back in 2015, no, I would not, because of the lack of information. And what would I do differently? I would just research the companies more and put less faith and trust in the companies and their owners, which is, I was very naive, 8 or 9 years ago. I just put a lot of trust in the people running these companies, thinking they were competent. I thought, how could somebody run a lending company or a finance company and not be competent? That doesn't make any sense to me. So I just gave them so much trust. And of course, I got some of them to come on the Financial Thing YouTube channel. I interviewed them. Some of them I got really good vibes from, and some of them I felt were somewhat smoke and mirrors. Also, I had to be careful with that. For example, when I had the Lendy guys on here, and I felt like Liam, he was a bit of a showman, and I had that niggling feeling that something wasn't right there. But I also have to be a little bit careful, because if I get on here and start saying things negatively about a company when they're existing, they can come after me for libel. So I have to be a little bit careful with that, unfortunately. But I didn't have enough foresight to understand that what was going on at Lendy was particularly bad, and I just gave them too much faith, too much trust. A couple of the people I worked with over at Lendy who I thought were really good people, and I still think were good people. Fortunately, some of the people running it weren't. So that's what I would do differently. I would make sure I research the company more, really deep dive into the owners, and check on their competency, and try to look at the company's financials and see if they have enough money to float them through bad times, because bad times do come. If the company doesn't have enough cash flow to float them through, or enough investment money, seed money, they're going to fail. I mean, look what happened to Able Rate. Failed because they didn't have enough money to carry them through the bad times and some of the bad loans that they wrote. So good question, Barry, Captain Barry. Appreciate that. Let's take a quick look. I'm going to try to run through this quickly. But this was the Able Rate original email that was sent out in December 22nd of 2023. This is going to be the bad news part of the stream, so hang in there. There is better things to come. This is when Able Rate sent out the letter saying, with a heavy heart and deep regret, aviation and tech capital, aka Able Rate, was going to be put into administration. And then this administrative proposal came out in March of 2024. It was signed on the 11th of March. It had some interesting things in here. Some of it was, I would say, waffle, but Quantuma is the company that's handling the administration. Some of these administration proposals can be very dry and pretty boring. Sometimes they can be a little tricky to understand. I always go straight to the proposed fee section, because these are what tends to get these companies and what really sucks the money out of the companies during administration. But you can see here, Just the solicitor's fees alone estimated at £450,000. Again, that's an estimation, and every single one of the administrations that we have seen has run way over the estimations by 3 times, sometimes 4 times. So you can imagine if the estimate's 450 grand, it's going to be much more than that when it actually gets sorted out, especially these able rate loans, which are quite complicated. So there are some other things in here. This was a interesting one. Ethical considerations prior to the joint administrator's appointment. A review of ethical issues was undertaken. No ethical threats were identified. So that's a piece of positive news. They have instructed TLT LLP. Try saying that a lot when you've had a few drinks. TLT LLP. A firm of lawyers with appropriate expertise and experience dealing with these types of administration. These are the ones that are going to charge us all the money. If you're an able rate investor and you got money in it. Should any creditor have any concerns about the way in which the company's business has been conducted or the information on any potential recoveries for the estate, they're invited to bring them to the attention of the joint administrators as soon as they are able. So if you do have any information, contact them. There are no secured creditors that are known of. That doesn't mean that some can't pop up. There's no preferential claims and no unsecured claims other than £32,400 that able rate used for legal fees to go after one of its debtors that it failed to get that money back. So that money is technically owed to them. So if we go down, contact information too on this report. Neil Allen, 02382357956, or email neil.allen@quantuma.com. So you can contact them if you have any questions about anything in here. By the way, I tried to get David Ward to come back on the screen, talk about this, but for obvious reasons, he probably doesn't want to. Pre-administration costs, let's talk about the fees. This is what they're proposing. Pre-administration costs are defined in the insolvency rules as fees charged and expenses incurred by the administrators and their firm. This statement outlines those fees and expenses where approval is being sought to pay for them from administration funds. This is pre-administration, by the way. This is not even in administration. These were the fees that were racked up before it even went into administration. That was £94,051. It's a lot of money. You can see here, this is estimated financial position of able rate. Not very good. They do have some cash in the bank. It is kind of a run on there's an umbrella company. Able rate is the kind of doing business as company that is under the main company, so it doesn't have a lot of assets. Here we go. Total fees and expenses. This is for the able rate part. £611,722 estimated. I would imagine that number is probably going to be at least double. The joint administrators are seeking to be remunerated on a time cost basis. These fee estimates are difficult because from a administrator's point of view, they want to do it on time cost. From an investor, I have money in able rate loans. I want a fixed amount because I don't know if you've ever hired a contractor or a builder based on time cost, and the builder says, I'm going to just charge you per hour. You don't know what those hours are going to be. It could be 1,000 hours, it could be 100. It's up to the builder, right? Same with these administrators. They could take as much time as they feel they need, and that can really get expensive. Look at the rates some of these people are making. In the London office, these CEOs making £730 an hour. Even the support person is billing $155 an hour. It's a lot. It's a lot. I think personally these fees are going to go well into $1 million, probably $1.5 million. If I had to take a guess, you can quote me on that. One of the other interesting things on this report, which I thought was terrible, It was terrible because, well, first of all, what is it? Number two, a creditors committee will not be established. This is terrible for anybody that has money invested through this company or through their loans, because you will not be represented by a creditors committee. And the creditors committee for lending and funding secure has been extremely valuable to people that have money invested in those companies' loans. The fact that there will not be a credit committee for Able Rate is really bad for you as an investor. One of the problems I saw in here was that this was sent out. I don't know exactly what date it was sent out, but it was signed off on the 11th of March. And it says here, all objections and proof of debt must be delivered by the decision date of the 25th of March, 2024. So you're telling me, and it was the same for the creditors committee. You see down here, creditors are invited to nominate creditors by sending nominations in writing to the joint administrator set out above. All nominations must be delivered by 4 p.m. on the 22nd of March, 2024. So if this is sent out on the 11th of March, Quantama gave you 11 days to band together as investors and come up with a creditors committee, if I'm reading this right. 11 days. A lot of people don't even read these things for a couple of weeks. They sit in their inboxes. And I think that's really, really bad. I think that should be questioned 100%. I think that there needs to be a creditors committee for Able Rate. I hope there is one. But to give only 11 days to make that decision and to object is really terrible. We look at the other report, and by the way, thank you to Peter Vince for sending this to me, because I wasn't able to access Able Rate's website because I'm in the US. Apparently they block it. But there are some fees proposals on here also. See if I can scroll down and find it. So this is Aviation and Tech Capital Limited, which is the umbrella company in which Able Rate operates underneath. So you got to do the administration for both, which is hence why it's called joint administration. The reason why you should care about this, by the way, is because if an administration happens to a company that you're invested through that's operating now and continues not to operate in the future, these are the types of things you're going to be facing as an investor through the loans. Hopefully we're not going to see too many more of these badly run situations and badly run companies, because I think most of them are being run well now. You can see here, this is part of the Aviation and Tech Limited Administration debt. Right now, this is pre-appointment expenses. This has already happened before we even went into administration. Another £86,362. Total unpaid pre-administration costs outstanding, 150 grand. So you can see here, this is 64,000 for Able Rate and 86,000 for Aviation Tech Limited. So those fees racking up. This is why I say administration fees are going to be way over $1 million. Okay, you can see here, there's a lot of money that's owed, right? A lot of money. And here we go with another estimation of total fees and expenses, 1.12 million pounds. So we're saying here, some of this doesn't make any sense to me how they come up with these numbers, but total fees and expenses right here, 1.123 million. So if I had to take a guess, it's probably going to be closer to 1.5 million by the time all said and done. Good things to know about if you're an Able Rate investor, whether you'll get any money back. It's probably going to go like the Lendy one, unfortunately, just because the fees are so much. You got the lawyers right here. Look, solicitors fees $450,000, so that's just for this one. You got $450 for the other one, I'm presuming. Lawyers are the real winners in these situations. Another thanks to Peter Vince for sending me this. I did actually get this email, but I drifted over this part and missed it. Right now for the ISA season, so until tomorrow, you can now invest through a Shojan project at a minimum investment of $1,000. Normally it's a £5,000 minimum investment, so they're giving you a bit of a break. Try to get some of that money in pre-ISA. Shojin also, I like this, they're being a little creative with the information that they're offering investors right now, which you can, I don't know if you'll be able to hear this. I don't think you can. But this is Jackie Chan right here. Is that really his name? Because that's pretty cool. Jackie Chan is taking you on a site visit. So you can see it's a project that Shojin is funding in Surrey. Jackie, he takes you to the actual location, walks there, and shows you what they got going on there. So that's interesting. Also, Lend Invest doing the same thing, showing you some of the project developments that they're funding now, showing you the building works going on. And I think that's a good thing. I think it'd be nice for more peer-to-peer lending companies to show us what is actually going on at these sites mid-visit. So that's cool. Wow, we have a lot today. I'm trying to get through this quick. I didn't realize it was so much. Don't forget ISA rules. This is going to change from April the 5th. The ISA tax wrap will be extended to include long-term asset funds, also being able to open multiple IFISA accounts during the year, where it used to be only able to open one in each category. Also, LoanPad has a really, really good article on their blog about their wind down plans, because we do talk about these administrations. We just talked about Able Rate. In January of this year, the Financial Conduct Authority issued a stern warning to peer-to-peer lending companies. Confirm your wind-down plans or risk losing regulatory status. That meant that every peer-to-peer lending company had to submit a really good wind-down plan that the FCA had to authorize. Otherwise, you could lose your FCA authorization. LoanPad has had a robust wind-down plan in place since 2019, which is updated and reviewed regularly. The wind-down plan details how LoanPad will protect investor money should the business cease operating. What does LoanPad's wind-down plan look like? There's 3 ways you can run a wind-down plan according to the FCA. Number 1, platforms can maintain a segregated amount of money which can be used to wind down the platform. Number 2, a third party can be appointed to take charge of the platform's portfolio and manage the wind down of the loan book. That's what's happening at Able Rate, so expensive. Number 3, the platform winds down its own loan book based on the resources that it has in-house. Inherently much cheaper, however, more risky. LoanPad has opted for that third solution. The platform has built bespoke software that helps manage the wind down for LoanPad, ensuring that investors are aware of what is happening and receive regular communication through the wind down process. The company, in line with their FCA requirements, has also set aside money to cover the costs of the business through a wind down. The pool of cash has increased as the business grows. Furthermore, LoanPad's lending partners all manage the loans on a day-to-day basis and must report to LoanPad at set intervals. They also agree to take a first provision loss, very important. Every lending partner takes a stake of at least 25% in each loan, which means they agree to take that first 25% loss of any loan that defaults. This provision helps LoanPad to mitigate the risk of investor losses in any circumstances, including a wind down. How likely is a wind down? I like the way that LoanPad is very upfront about this. The economic volatility of the past few years has shown that there are no guarantees in finance. However, LoanPad has put a number of measures in place to ensure that investors' funds are protected as possible. LoanPad has been a profitable company on a monthly basis since 2022 and maintains financial resources significantly in excess of those required by the FCA, including a maximum loan-to-value, origination of lending at 50%. In the event of a LoanPad wind-down, all loans will remain active, and the loan book will be managed as usual, albeit without the addition of any further loans. So I think what I get from that is how likely is a wind down situation in the loan pad. I would say pretty unlikely, but there is always that possibility. As with any company in life, they can always go bust. But loan pad is very transparent about how they have things set up in case something does go wrong. And I would say if loan pad ever went into wind down, it might be one of the situations where investors would receive a heck of a lot back more than we're seeing from the other companies that have gone into administration, like Landy, Funding Secure, and all those wonderful companies. By the way, if you're enjoying the stream, please hit that thumbs up. I know Holly's enjoying it. Let's put her to sleep. But yeah, please hit that thumbs up. It makes a difference. Only takes a second. I definitely missed over this. I can't remember if I did or not. I think I did. Assets Capital is initiating a £1 withdrawal fee that was introduced 18th of March 2024. Every time you want to take money out of Assets Capital, they're going to charge you £1. Kind of ridiculous. It really is kind of the cherry on top of the Assets Capital poo pie. The reason they're doing this is because people who get £6 deposited into their account are hitting withdraw, and they can't be bothered, or it probably takes manpower for them to manually send out those payments to people. So they're trying to say, please wait till you have a decent amount of money in your account before you withdraw. Number one, we're going to charge you £1. Plus, the less times people are withdrawing, it saves them on resources and money. Not actually uncommon. There's a company in the USA called Upside that does that. Basically, you get discounts on petrol. You get cash back. So from every gallon that you put in your car, there's certain petrol stations, they have the same thing with the withdrawal fee, because again, it takes money and resources. If you're withdrawing when you got £5-6 in your account, they do the same thing. They charge a US dollar to withdraw the money to your bank account that you've gotten from cashback fees. So not uncommon, really annoying though, especially with assets, considering all the crap that they have poured on investors with their management fees and whatnot. And then on top of that saying, we're just going to nickel and dime you, as we say in the US, to death, charge you £1 every time you want to make a withdrawal, whatever. I want to talk a little bit about Property Moose, one of my really, really old school investments that I had major good thoughts for, and then ultimately another one bit the dust. Property Moose was a very much like the house crowd, where they used to sell ownership shares in SPVs of houses that were bought as rentals and other types of investments. Ultimately, the boss over there, Andrew Gardner, decided he could not see this company working out financially, and decided to make a change where all of the properties that were owned were put into a big pool that was renamed UK Diversified Property or something like that, and all of the owners will become shareholders in this new fund and hopefully receive money back from that. What essentially happened is not really very much. The properties went into a fund. People didn't receive any dividends. They were given buyout opportunities at discounted rates. So, for instance, if you had £1,000 invested in Property Moose and now you're in this UK Diversified Property Fund and you wanted to get out, they were offering, I think it was 20p on the pound. It wasn't a good deal. The first time that was sent out to me, I said, I think I had about £3,000 invested, and I thought, I'm going to take my chances, because 600 off of 3,000 or whatever, I had 2,700. It's not really good. It might be worth just rolling the dice and seeing what happens. Kind of years followed with that, and it just didn't do well. Nothing really seemed to be moving forward, even though they were trying to liquidate the properties inside the portfolio so they could pay people back. It was just taking years and years. Meanwhile, money was being tied up and you're not getting any returns on your investment. So eventually, I think maybe the second or third time a buyout was offered, I said, I'm just going to take the buyout. I didn't like the fact that, number one, I do like Andrew. I think Andrew tried to do a business that he had good intentions for. It just didn't work. Sometimes it's like that in business. And he tried to save investors money by not doing an administration like the house crowd did, and that's a disaster. But ultimately, the diversified new business, I thought, I just didn't have a good feeling. One of the things that I was concerned about is I would email them and they wouldn't reply. I couldn't get a reply, and there was no phone number to call. It was very hard to reach anybody. I personally had a direct line of communication with Andrew, so I was lucky. But it didn't make me feel good. It didn't make me feel good for other investors out there. So when that offer of a buyout came the second time, I think it was a 30% offer, I just said, I'll take the tax loss. And at least it's better to come out of there with something rather than nothing. I also didn't like the fact I would go to their website, try to get tax information. Last time I went, the website was up and I just couldn't log in. But this one now is coming out with an error. This is ukdiversifiedproperty.com. I don't know what's going on with them. But I wanted to give you an update about what happened with them and be kind of transparent about what I personally decided to do. I know some of you out there are still invested in this company, so just be wary and keep an eye out for what's going on and consider that buyout if it comes around, because who knows what happens in the future. Trading 212, let's take a quick look. 20,475 gone down a little bit in the portfolio. Mostly due to Coinbase dipping down a little bit. Bitcoin took a bit of a pullback from 68,000 US dollars back to 66. Of course, when that happens, Coinbase shares tend to retract. But the portfolio is still performing okay. I did think about dumping these Alibaba shares now, but I decided to hold on to them for a bit. Personally, I'm not sure what's going to happen with them. Valco Energy is still doing well. We're 64% up now. And what's crazy is it just shows you how important it is to be patient. If you look at this one-year graph of Valco, you see how it did absolutely nothing, just bounced kind of up and down, almost for an entire year. So March, look at that, entire year of nothing. Then all of a sudden, bang, it pops. When you have a thesis on a company and a reason why you invest, you're looking for this pop. And you just don't know when it's going to happen. There was a false pop right here when we thought it was going to happen. It didn't, ultimately. But Valco's been doing good. Of course, there's always that 20/20 hindsight thinking, I wish I'd put in more. But there you go. And Coinbase still, we're almost up 95% on that. What I did do was I dumped a stock this week. Decided to take the tax loss before the end of the tax year. So I don't like taking usually losses, but I sold out. And VET of Vermilion Energy, you can see these three fills here of about 868 pounds, which put in the negative. You can see here negative 256 on that sale, negative 230 on that sale, and negative 114 on that one. So took a loss, but VET has been actually really good to the portfolio over the long run, because this was a liquidation and repurchase of shares when I'd sold VET, I think about a year before that, when the oil had done really well. So even though we lost some there, it wasn't really a total loss because we'd made some really good gains on VET before. So right now the portfolio is made up of basically 6 stocks. Creative Realities will be sort of hanging on to that for a while. Green Power is down so much now at this point, 60%. There's no point in dumping it unless, again, probably next year for another tax write-off. Rivian, again, it's not been performing well. It seems like these electric car companies not doing so well. Tesla also struggling due to the release of their orders. They made more cars than they're selling. And then Alibaba not doing well, so got a lot in cash at the moment, 9,123 that's getting interest right now at 5.2%, so not terrible until we see an opportunity to go into another position that's probably just going to sit in cash for a while. So we got about 11,000 invested. So sitting about 60% stocks, 40% cash. Pretty well balanced. Anyway, that is what I have for you this week. Hope you've enjoyed the stream. Hi, Mike Powell. Hi, Darren in Cambridge. Colin Perry in the Peak District. Paul Bagworth from Kenilworth. Not raining. Peter Vincent Leatherhead. It's a little bit wet. John Day in Nottingham. Anyone decided on their favored IFISA 20,000 split for 24 and 25 or sticking with just one? I think splitting it up is probably a really good idea. Mike Powell says a bit of a difference between banks offering incentives for accounts as it relates to non-reliable assets. Yeah, I agree with that. Yeah, I'm not talking about banks, Mike. I'm talking about stocks and shares companies and other investment companies that are allowed to offer incentives. Banks, obviously completely different. Aki Chap in Accrington. Patty is in France. Bonjour. It was sent out 10 days before. So that the able rate administration, 10 days before. I just don't think 10 days is enough. I mean, sometimes I don't read things straight away. It's not really enough. Dave Dawson likes the wind down plans. Me too. Mike says you get one withdrawal, free withdrawal every 3 months. There you go. So obviously I didn't read that entire thing. Because sometimes I don't. Thanks for pointing that out. One free withdrawal every 3 months. That's still kind of stingy, though. What if I want to withdraw my money out every month? I have to pay £1. I don't want to pay £1. Patty said administrators are in position of absolute power. The strong do as they will. The weak do as they must. Really great point. Stephen, normally from Nottingham, sailing back to Fort Lauderdale from, at the moment, on RCL, Liberty of the Seas. Enjoy your cruise. Hope you have good weather. Am I going to apply for the Trading 212 card? No, I'm absolutely not. Yeah, we could track Stephen on the cruise if you want to track it. You could track that cruise ship going over to Fort Lauderdale. You're going to enjoy the weather here. It's absolutely nice. It's beautiful. I'm going to go outside anyways now. So anyway, have a wonderful weekend. Thanks for joining in. Thanks for tuning in. Don't forget, check out Cufflink. They are a very generous sponsor of the stream. Be back next Thursday. Don't know if we're going to have a guest next Thursday or not. Hoping the week after. If not, we have Crowd Property at the end of the month schedule. So get Mike Bristow on here to talk about CP and what they're doing over there. But that is all I got. Have a nice weekend. Enjoy your weekend. Remember, there's more to life than money. So get out and enjoy yourself. Thanks for joining. I'll see you next week. Much love to everybody. Take care.